Well, YouTube, I'm told it's over. Pack it up because the economy's collapsing, the stock market's nosediving, and it's pretty much instant ramen on the menu from here on out. Just a month ago, the Atlanta Fed was projecting that the U.S. would have real GDP growth north of 3%. And here in early March, they're now projecting we could have an economy that declines by almost 3%. So is it time to panic? We're going to talk about the economy. We'll talk about stocks, earnings, portfolio updates, China, government bonds, crude oil, you name it. So let's dive right in. In just a couple of weeks, investors went from being optimistic about the economy and the U.S. stock market to being very pessimistic because of a growth slowdown or growth scare. And one of the main drivers of this growth scare is the Atlanta Fed's GDP Now model. So the Atlanta division of the Federal Reserve has a forecast model it puts out called GDP Now, which estimates the current quarter's GDP growth. It takes in a bunch of inputs like retail sales, existing home sales, ISM manufacturing numbers, personal income and spending, and then it spits out this output. And at the end of January, they were estimating that it would be 3 to 4% positive GDP growth. But by the end of February, this number had flipped to almost negative 3% contraction. So cue the cringy thumbnails and the doom and gloomers. But if you look a little bit deeper into this GDP Now data and look at the subcomponents of the data, there's an interesting story here. So if you look at all the different categories that make up GDP, there's one category that's having an outsized negative impact. And that negative impact is coming from net imports. So why are net imports surging? Well, we know that the Trump administration has been attempting to levy tariffs on goods coming in from Canada, Mexico, China, potentially the EU. And even though some of those tariffs have been delayed, it's causing a lot of uncertainty. And so manufacturers and importers of goods have been trying to import as many of their goods as they can before these tariffs go into effect. So that's creating this huge pull forward in imports. And if you think forward at some point, that may reverse. But right now, it's creating this big negative impact. Now, if we look at other categories of GDP estimates, other categories that go into GDP calculations, there are some other subcomponents that are declining. One of the more concerning ones is the consumer spending portion of GDP. So we saw the January consumer spending fell from about 2% to positive, well, call it 0.75%. So it's still positive, but it's fallen quite a bit. Now, there's probably some impacts from weather and the fires in California. And so we don't know if this weakness in consumer spending is going to persist, but it is having a slight negative downward effect on GDP. Now, some people thought maybe it's the government budget cuts or the DOGE efficiency efforts that are creating an impact on GDP. Well, we're not actually seeing that in the government spending component of GDP now yet. So DOGE is attempting to cut quite a bit of fat in the government, which is good, and they claim $105 billion of savings already. But the overall U.S. budget deficit is 1.7 or 1.8 trillion, and the overall budget itself is almost 7 trillion. So this is still a very, very much a drop in the bucket when it comes to government spending, and it's not really impacting the overall GDP number yet. So let's talk about these tariffs, because tariff uncertainty is not just hitting the GDP numbers, it's having an impact on both businesses and consumers that could have significant downstream effects, not just for Q1, but potentially for the rest of the year. If you look at the ISM manufacturing reports and the ISM services reports, there's a bunch of comments from the businesses and consumers that were surveyed about the impact of these tariffs. And you can see I've highlighted some of them here, but a lot of businesses in particular are concerned that tariffs are going to impact their customer spending. They're worried about the impact on their supply chains, where they're going to source their goods from, how or if they're going to be able to pass along the tariff price increases. And so this is creating a lot of planning uncertainty, a lot of forecasting uncertainty. And that's going to have some effect on business confidence, consumer confidence. In fact, we're already starting to see some of those confidence estimates in things like the consumer or the Conference Board's estimate of consumer confidence. That ticked down recently. We had the Michigan consumer sentiment data for consumer sentiments tick down as well. We've had other measures like the NFIB measure of small business confidence go down. So we're already seeing a negative impact from these tariffs. By the way, it's not just tariffs that are creating uncertainty out there. The Trump administration brings a lot of uncertainty around a lot of areas, including new immigration policies, new energy policies, geopolitics, how they're handling the Russia-Ukraine situation, how they're handling China. Potentially, there could be changes in the budget, changes in taxes. So there's a lot of uncertainty out there for investors, for consumers, for businesses. When we survey consumers, inflation is still top of mind for consumers. And there's a big question out there as to whether or not the Trump administration is ultimately going to be deflationary or inflationary. If you look at 5-year break-evens, if you look at the market's view on that, you can see that after the election, the market basically pushed yields up, thinking that Trump would be inflationary. But lately, that number has ticked down. And basically, if you listen to what the Treasury what Trump's Treasury Secretary, Scott Bessent, is saying. He's basically saying that they want to potentially put some downward pressure on the economy in the short run to bring yields down, to bring the cost of government borrowing down, but then potentially set up an opportunity for longer-term economic growth that's driven by the private sector. So it could be one of those situations where we face more deflationary conditions short run and then ultimately get more inflationary conditions on the back end. And I showed this chart a couple of weeks ago in one of my videos showing the drawdowns in the S&P 500 during Trump's first term, and we had a lot of big corrections. Obviously, this COVID one was the worst, but even outside of that, there were a lot of big 5 to 10% corrections during the first Trump administration, and I think this one could have even more volatility and uncertainty than the first term. So yeah, basically I said brace for impact, and we're already getting one of those big corrections here in the market. But listen, it's not all bad news out there on the economic front. Look at retail sales, for instance. We know that consumer spending may have slowed down a little bit in January, but the official retail sales data still shows year-over-year growth. In fact, if we look at the Redbook measure of weekly retail sales, it's picked up since January, and retail sales are still growing over 5% year-over-year, according to Redbook. We also have low unemployment rates. In fact, we just got a jobs report today for the month of February, and that showed unemployment sitting at 4.1%, still very low. And in fact, the U.S. apparently added jobs in the economy last month. Even though the government sector lost 10,000, there was a net increase in jobs of 140,000, so the private sector was more than carrying its weight. We also have seen a decline in government bond yields in the last 2 months or so. Interest rates are retreating, so that should help with borrowing costs. It should help reduce the 30-year mortgage rate, for instance, potentially could reduce borrowing rates for corporations. We're also seeing a rise in the probabilities for more Fed rate cuts this year in the official Fed funds rate. In fact, the market's now pricing in about 3 rate cuts by the end of 2025. So the Fed funds rate is currently sitting around 4.25%, and that could come down, according to the market, to about 3.5% by the end of the year. So that does beg the question as well, could that actually improve this moribund housing market that we're seeing? Because we've seen a flat line in existing home sales. New home sales have been pretty low. And if we do get a decline in rates and then that flows through to 30-year mortgage rates, I do think we'll see a pickup in the housing market, which has been at pretty low levels of housing activity in the past 2 to 3 years. We're also seeing a decline in oil prices, which helps consumers' pocketbooks. And so we've seen crude go from almost $80 a barrel at the beginning of the year to around $66, $67 a barrel as of the time of this video. So that's great news. Of course, one of the big drivers there is that OPEC is actually adding more production in again. I think Trump's had some impact there on OPEC's decision, so that's a positive. So we're seeing oil prices lower, and that ultimately should be good for consumers. We're also still seeing pretty robust earnings from companies, especially in the S&P 500. The S&P 500 earnings projections are still for growth of about 10 to 12% in earnings growth for 2025. So that's overall a very, very healthy number if companies actually hit that. So I'd say overall, it's probably too early to panic about a recession. You know, we have this weird import data happening with the GDP now figure, and we have seen some areas of slowdown. But overall, if we look at the totality of the data, I think it's probably too early to say that we're headed into recession and that everyone should panic and, you know, that we're all going to be unemployed and eating ramen. So, all right, enough about the economy. Let's talk about what's been going on in the stock market. So the S&P 500 is currently down about 6 to 7% from its peak on February 19th. And as far as corrections go, well, that's a pretty modest one. I've shared the base rate data before, but we get a 10% correction in the major indices about once every 2 years, and we have more significant corrections than that pretty frequently. So I'm a little surprised to see that we already hit the extreme fear reading on the fear and greed index with just a 6 to 7% correction. I mean, I kind of shudder to think what things would look like if we actually had a 15 to 20% correction in the overall market. So I think people need to put their big boy pants on here. But nonetheless, if you look a little deeper than the overall indices, you can see that some stocks and some ETFs have pulled back pretty significantly already. In fact, the SOX, the largest semiconductor ETF, which holds stocks like NVIDIA, AMD, Qualcomm, Broadcom, etc., that's pulled back about 25% from its peak just last summer. So that's a pretty big drawdown from peak, especially considering that we're still in kind of this AI boom. We also have seen the Magnificent Seven stocks pull back and draw down almost 16% from peak, which is pretty sizable for, you know, some of the largest companies in the world. We've also seen a lot of popular momentum stocks that have pulled back massively. So companies like Tesla down over 30% from peak just in the past month or so. Coinbase, Reddit, AMD, Rocket Lab, Hims & Hers, you know, some of these stocks are down 40, 50, 60% from the peak just a few weeks ago. So those are interesting. And I think part of what we've seen in this most recent correction is this momentum unwind. You know, we got so overbought on some of these hot momentum stocks at the late last year and the beginning of this year that it was due, no matter what the economy was doing, we were due for a pullback in some of these Momo stocks. And ultimately, I think that's what we're seeing as a big part of this correction. Looking outside stocks, crypto's also had a pretty significant decline. Crypto's down about $1 trillion in aggregate since the end of December, or down about 25% from its peak. And in areas like meme coins, you've seen an even deeper drawdown. Meme coin values are down over 50% in aggregate. So if you were out there top blasting fart coin at the end of last year, you've had a pretty tough time lately. And that brings us to an update on my 100K portfolio that I funded last fall. So the last time I showed you this portfolio a couple of weeks ago, it was up, I think, around 9%. It's now up about 6% since October. So it's had a pullback with the recent pullback in the market, but still outperforming the S&P nicely because the S&P is actually down a little bit since last October now. But you'll notice when you look at the current portfolio holdings here, there's a couple things missing. Namely, the call options that I had on Alibaba, which expired in January 2026, and the call options on Tiger, which expired this March. I exited both of those positions. Even though the Baba calls I wanted to hold longer, there's a reason that I decided to exit. We'll talk about that in a minute. You can see the portfolio holdings here. I'm going to talk about some of these new positions. You can also see that the portfolio has still about 63% in cash, but that number has been slowly coming down as I add exposure. So let's talk Alibaba. It was one of my favorite positions going into the year. The stock was up over 60% through mid-February. Things are going gangbusters. The Chinese tech sector was helped by the DeepSeek news, the shift in sentiment that was happening there with Chinese stocks. And then bam came the hammer from the Trump administration, which announced this America First investment policy in late February. And you can go read through that document and see all the things that they laid out. But one of the more concerning passages was this one, which laid out that they could put new restrictions on U.S. investors' ability to invest in Chinese companies that are operating in industries like semiconductors, artificial intelligence, biotech, etc. And Alibaba is very much involved in artificial intelligence. They're seen as one of the leaders in Chinese AI because of their Quinn model and their cloud business. And so it's possible that U.S. investors could be forced to sell Alibaba. Now, is it a high probability event? It's hard to say, but certainly the probability has risen given this America First investment policy. There were also some provisions in that policy that laid out the potential for restrictions on these VIE structures that Chinese companies like Alibaba use to list in the U.S. And just given the deteriorating nature of the U.S.-China relationship under Trump, and now it's laid out that they can take more dramatic actions, I had to reduce some of the China risk, particularly around call options, which, could very quickly decline in value. And by the way, I was up 500% on those Alibaba calls, so it wasn't such a bad thing to take profit on the rest of the position. But I had to reassess. I always like to say, one of the main reasons you might sell a position is because the thesis has changed or something overall fundamentally has changed significantly. And I think the America First investment policy was a significant change. Now, I do still have some Chinese exposure. I actually added the Chow ETF, which is a leverage ETF on the CSI 300, which is an index of Chinese companies from the mainland of China. Now, could that also have some delist risk? Probably, but maybe a little bit less direct risk than, say, Alibaba, which is in one of those categories that they spelled out in the America First investment policy. So I also have some Tiger stock as well still. So overall, the exposure is about 4% in Chinese stocks, but no call options. So, I will say taking profit on the Baba calls did help the overall portfolio. So it wasn't all bad, but I just wish that I could have held those a little bit longer. I just felt like I couldn't hold them given some of this new information. Now, of course, Chinese stocks, they do still have opportunity, especially in this market with investors shifting sentiment and shifting capital towards other areas outside the U.S. market. Just look at the DAX, for instance. Like we've had some pretty crazy moves even in European stocks that have gone parabolic this year. And of course, the Chinese market has done very, very well as well. And we've seen stimulus measures coming out of China just in the past week or two. So that's also going to help the Chinese economy and potentially Chinese stocks. So I wanted to have some exposure, but not directly to companies like Baba that have a direct link to some of the restrictions mentioned in that America First policy. So I want to answer a question I got in the comments of one of the previous videos, which is why would you invest in a company whose revenue is deteriorating? And I think he's referring to Etsy, which is not seeing a lot of revenue growth at the moment. And the broader question is, why not just buy the fastest growing businesses you can? The reason is valuation and price do matter. You look at the example of Cisco, In the dot-com boom, they were growing triple-digit rates on revenue and bottom line, and it looked like they were going to grow to the sky and keep growing forever, and you could pay almost any price and you would make money. But look what happened. Obviously, the dot-com bust happened. Cisco stock did not break even for like 20 years. And if you look at the fundamentals were growing during that bust time. The fundamentals were growing in the post-dot-com boom. Revenue grew, free cash flows continued to grow. But if you'd bought at too high of a price, you would have had a negative return for a very long time. I think today, we talked about this last time, but investors were probably getting a little bit too far ahead of themselves on Palantir, which is already starting to pull back, paying almost any multiple. It's a great company growing at a good rate, but, people were overpaying for this thing at a certain point. So I like to try to find great businesses at reasonable prices. Now, those are going to be a little bit rare. More often, you're going to find good businesses like Palantir at high prices. And that sucks, but you don't have to swing at those. You can wait for companies to get cheaper in a correction. You'll also see a lot of value traps. You'll see, bad businesses like just perpetually trading at what look like low multiples. So I don't just go out there and buy low multiple companies all the time either. A company like Ford, for instance, perpetually trades at 6 or 8 times earnings, but you never seem to get returns from it because, the business just never seems to get out of the hole that it's in terms of profit growth. And then there's, of course, bad businesses you don't want at any price, which would be something that's diluting you or unprofitable, something like Tilray, which, again, has just burned cash year after year after year and diluted shareholders and raised more equity. And it's been a terrible return for investors. So there are businesses you don't want at almost any price. But I do want to find the good businesses at the good price. It just takes some effort and takes some time. Sometimes you have to be very patient waiting for those. And ultimately, valuation matters because if you can buy a company at a cheap multiple and then it grows, you're going to get the dual tailwind of the potential for earnings growth and the potential for multiple expansion. So think about buying Apple at 6 times earnings in 2012 when it had a lot of growth ahead of it. That's going to be a better deal and you're going to get a lot better forward returns than, say, buying Apple at 30 times earnings when it's barely growing. And so that's why, again, valuation matters. So let's look specifically at Etsy right now and what I see here. I did actually reduce the position, not because of that comment, but because there was a concern I saw in the fourth quarter. Now, you can see here in the fourth quarter, they had their gross merchandise volumes down almost 7%, and that was a steeper decline than they'd seen in prior quarters, and that was the main reason for my concern. You'll also see, by the way, they were still able to grow revenue by 1% in the quarter on a year-over-year basis. That's because their take rate increased. They can't increase take rate forever, but they're actually technically still growing revenue here. The bottom line, EBITDA grew by 6%. So they're controlling costs and doing what they can, even in a period where merchandise volumes are down, which is great to see. And I think overall, is Etsy a good business? You look at the gross profit margins, 72%. The free cash flow margins are very high, 26%. You look at something like return on invested capital at a mid-teens rate. These all indicate that Etsy's a good business. As I think about the moats around the business, there are some competitors, Amazon, Temu, other platforms, but Etsy has a really good, strong network effect in its marketplace. They continue to add product features. I think there's some categories that are cyclically weak for them right now, but you look at the overall business, it's, not capital intensive. It can be very, very cash flow generating. They're going to buy back stock. I think overall it's a good business and it's trading for like 8 times free cash flow. So you're getting it at a good price. You really just need to see growth improve at some point, and I think it could be a big winner. So I did reduce the position size because of the steeper decline in merchandise volumes. I want to make sure that this thing isn't going to be, declining forever in terms of merchandise volumes, and maybe they're just losing market share. That could be, there's potential for that. But I still like the position overall, at least at some exposure levels. So I've said a number of times that market corrections are an opportunity to add stocks to your portfolio on the cheap to give you really, really good forward returns. And I've showed this chart before. You can look, even the largest companies in the world go through really deep corrections when you have a market sell-off, and those can provide for really, really nice returns. So am I taking my own advice? Yes. I've been adding positions to the portfolio, including AMD, Block, PayPal, Wayfair, Abercrombie, and TSMC. So let's talk about the payments platforms, PayPal and Block, which is now under ticker symbol XYZ. I consider these both growth at a reasonable price. You look at both expected to grow earnings at a double-digit rate for the next several years, and both are trading for around 13 and 14 times earnings, which is a significantly below market multiple for what I consider to be pretty good businesses benefiting from secular trends in e-commerce and payments platforms. They own significant, interesting consumer assets with Venmo, and in XYZ case, they own Cash App. So these are really good businesses that, are in a competitive industry, and there's questions about things like market share and Things like, will growth actually materialize long term? But overall, I mean, they're pricing in a pretty pessimistic scenario today. And if you get anywhere close to the estimated earnings growth here that the analysts are saying these companies will grow at, the prices are just far too cheap, in my opinion. So you can get a pretty good return on these businesses, I think, from these prices. Let's talk about Abercrombie & Fitch, ticker symbol ANF. So I added this position, and then I actually cut some of the exposure after the earnings report, even though I still hold some, and I think it still could be very interesting. The business has been on fire the last few years, so they've been seeing their core brands, Abercrombie & Fitch and Hollister, having a resurgence. They've been growing their comparable store sales at mid-teens rates for the past few quarters. Free cash flow has been inflecting. It's a very profitable business now. The balance sheet is very solid. And it is in retail, and retail can have some cyclicality with the economy. But overall, Abercrombie reported in their most recent quarter 9% revenue growth, comparable stores growth of 14%. They said that they're going to be opening more stores in international locations in the coming years as they're seeing success there. Margins improved last year, so there's a lot to like. They're also buying back stock. But one disappointing thing was that they gave kind of soft guidance. So they said for 2025, their sales growth outlook is in the range of 3 to 5%. That's a big reduction from seeing, say, 10% plus types of growth rates in 2024. So that gave me a little bit of concern that they may be seeing a slowdown or they see the economic environment changing. It's possible they're being too conservative on their guidance. They also have a huge buyback authorization they just authorized, so maybe the company just wants to buy back shares at a cheaper price. And it is trading for like 7.5 times this year's estimated earnings. So it's at a very reasonable multiple now after a huge sell-off from its peak just from middle of last year. So I think it is a good brand. It does appear to still have really solid traffic trends from what I can tell with Hollister and Abercrombie. But there is some fashion risk and there is some risk of an economic slowdown. So it's a small-ish position. But if they can exceed their guidance for the year, I think the stock can do very well from here. Let's talk about AMD. So I mentioned this one before. We saw a big insider buy on AMD a couple of weeks ago. It was the first insider buy since 2012. AMD is now trading at the same price to earnings multiple it was trading at when, or just before ChatGPT was released. So this is the cheapest valuation that we've seen AMD at in this AI boom era. They're also seeing an acceleration in the estimate that analysts have for their future growth rates. So if you look at the estimates of what they think AMD will grow at in the next 3 to 5 years, that number is actually up recently in the past year. And that makes sense because we're in a huge AI boom. AMD's server revenues are growing. They're coming out with new lines of GPUs. And so it's interesting to see growth estimates rising while valuation has come down. And now we're basically getting AMD at a market multiple of earnings, despite the fact that we're in an AI boom. And I think there's a lot of opportunity for AMD to actually take some market share from NVIDIA as we go forward. I think there's still some areas where AMD gives me some concern, particularly in areas where the business is weaker outside of the AI server boom. And of course, we could face a situation where AI server CapEx gets cut in 2026 or 2027. Maybe all these hyperscalers realize they're spending too much on the AI data center build out and there will be a consolidation period. But I think right now, from what we can see, we're only seeing companies increase their budgets for data centers. So I think AMD is in a pretty good position right now, and it's trading for, like I said, the cheapest valuation in this AI era. Now, that also brings us to TSM, which is also another AI beneficiary. But I also think TSM is probably the most important strategic company in the world. They are the leading edge semiconductor manufacturer. AMD, NVIDIA all depend on TSM. You're getting this business for a below market multiple, despite the fact that it's seen a huge increase in revenues and free cash flows in recent years and continues to grow. And I think will continue to grow as we see not only AI grow, but things like robotics and applications within automobiles, applications within just connected devices. And so I think, TSM is the leader, and really there isn't even a close second. I mean, look at Intel. Intel has struggled to catch up with to catch up with TSM on the leading edge nodes. And yet you can buy TSM for 17, 18 times earnings. Now, it's probably because you have people worried about this risk of China invading Taiwan and taking over TSM's key Taiwanese fabs. Well, if China invades Taiwan, guess what? Apple's going to be down 50%. The Mag 7 is going to be down 50%. The U.S. stock market's going to be down, very, very significantly. So I don't really see I don't buy the argument that TSM has this specific risk more so than basically every other tech company out there, including, by the way, NVIDIA. These are companies that depend on TSM as a critical supplier. And TSM, to their credit, is building out fab supply in Singapore and in the US, which will help diversify some of the geo risk. But of course, there's always going to be that Taiwan risk there. So, I don't want to paper over that risk, so to speak, but I do think TSM is not unique with that risk. And that brings us to our question of the week from Fabi in the comments. And Fabi is around 50 years old, saving about 70% of their income, which is an amazing figure, by the way. But they want to grow their accounts as much as possible for the next 15 years ahead of retirement. Do I have any tips on managing around the fear of investing because of a market pullback? DCA is the typical advice they get, but they feel the fear. They also feel FOMO at times. So how do you manage around fear and FOMO? And it's a great question. I like to show this chart from Ritholtz Wealth Management, which shows all the silly things we worry about in the short run as investors, whether it's natural disasters, inflation, government shutdowns, you name it. There's always something that we're worrying about in the short run. And yet you can see the market just trucks higher over time, regardless of that. Charlie Bolello has a great chart showing the returns of investors who buy the S&P 500 and then hold it. So if you hold it for 20 years, there's never been a 20-year period where investors bought and held the S&P 500 and didn't have positive returns. Even if you go down to 3 or 5 year periods, you're almost at 90% positive returns. So maybe the future doesn't look exactly like the past, but historically we see that buying and holding stocks has been a winning bet. So that should give you some comfort. The other thing that I think that can help you minimize mistakes and regret around these emotions that we all naturally feel is, if you make those contributions consistently and you're saving a lot of your income, that will help smooth out any short-term market impacts. So if there is a market correction, you're still going to be adding consistent capital, and that's going to give you firepower when it's best used, which is in a market correction, when you get these bargains on stocks. So that really helps to smooth out any market fluctuations, and contributions, especially at your savings level, are going to be probably more important than what is happening in the market at any given point in time. So keep making those contributions, and that's going to help that compounding of the portfolio. Other things like proper position sizing and diversification can help a lot as well. So I talk a lot about that in my videos. Not sizing anything too large or taking bets that are going to take you out of the game. And then also diversifying across sectors and styles and countries. Just look right now. I showed you the chart earlier of European stocks that are doing so well, and Chinese stocks are doing well, while the US market is down. And so diversifying across exposures can also help you to sleep at night and to be able to enjoy returns in any market environment. Now, you're not going to have the most maximum positive return if you're diversified, but it's certainly going to reduce risk and reduce stress. And then, of course, use the fear and greed to your advantage. You feel the fear and greed, but try to think about it. Try to flip it the opposite. When the market's correcting, think, this is an opportunity for me to buy stocks cheaper. This is actually an opportunity to potentially add something to the portfolio that I've been waiting on for a while that I thought was too highly valued. If you look at the data here, you can see when we get extreme fear readings, the forward returns 3, 6, 9 months, 1 year ahead of those, or 1 year after the extreme fear readings, tends to be amazing returns historically. So buying when there's fear is actually the best time to be buying as an investor. It's like when things in the store go on sale. So I try to reframe it. And when I see a correction happening, I'm like, awesome, this is great. I don't feel bad because the value in my account's going down. I feel great because now all of a sudden I'm getting all these bargains that I can add to the portfolio that I know in the future are going to go up. And the same is true on the extreme greed side as well. Like if you see that everybody is getting greedy and you're feeling the FOMO, maybe you should step back and say, okay, maybe I should trim some risk here. It feels a little frothy. Valuations are getting extended. Now maybe is a good time, especially on longer term positions, to trim a little risk, and that can work well also. So I think some of these things will help in the general framework of managing the emotions. And look, it's not always easy. We all fear that. We all feel the fear at times. Maybe the market corrects 5% and you're like, well, what if it corrects 10 or 15 or 20? I would get even better bargains if I just waited. Yeah, maybe. But are you going to be a perfect market timer? Probably not. Most of us aren't. So it's okay to kind of scale in as those things happen. You don't have to do it all at once. And again, contributions helps to smooth all this out as well. So I think if you think through those things, that'll help. Let me know if that's helpful. By the way, I talk a lot more about portfolio management and risk management in my stock boot camp. We're going to be doing a live version of that soon. So the wait list is in the description. Check that out if you're interested. But yeah, let me know about the new portfolio additions. If you like them, if you got any thoughts, if you think I'm an idiot, let me know in the comments, and I'll see y'all in the next video. Cheers.